So this is the VA loan breakdown. This is where competitors cover it, but without heart. So I think everybody needs to lock in. If you're a VA buyer, you're a veteran, you're active duty service member, you served in the reserves, you need to know about the benefit that has been given to you. And I think a lot of lenders talk about the VA loan and what you can do with it, but they don't really have a good understanding of all the mechanics that go into putting a VA loan together. From the beginning of time, this is probably the best loan ever, meaning performance-wise for the secondary market, they perform great because of how the VA looks at the loan itself. And then the ease of origination for a VA buyer, it really has a lot of different ways. I call it the Swiss Army knife of loans to be able to help the VA buyer get the money they need to buy the homes they want. There's a lot of myths, a lot of misinformation, a lot of different answers or rules around VA. And it's not the originator's fault that they're given wrong answers. It's just that they don't know enough about the VA home loan to give you the real answer. It's the company they work for. It's the lender they're sending the loan to that are giving restrictions. There's a lot of things about what we're going to share today with the VA home loan that will make you say, wow, I didn't really realize that I had been lied to or given misinformation that probably cost you thousands of dollars. The biggest myth that I think on VA loans right now is there's a minimum credit score. You got to have a 680 credit score to go VA, or you need to have a 620 credit score to VA. The absolute truth is there is no minimum credit score with a VA loan. So that means you could have a 450 credit score or you could have an 850 credit score, and both of those scores are eligible because the VA doesn't care what your credit score is. Now, we can get into some of the details or the mechanics for lower scores, probably means some credit issues and different things, but know this for a fact. The VA loan does not have a minimum credit score, and if you've been told that before and you used a different loan program because you thought you weren't eligible, that probably cost you thousands of dollars just in mortgage insurance and maybe out-of-pocket costs that you didn't need to put into the home. Second one, I would say, is there's no debt to income ratio, meaning when you qualify for a loan, you have effective income or qualified income. Like, this is how the lender determines what your stable, predictable, likely to continue income is. Now, it might be different than what you think you bring home or you make in a month or a year, but it's the way the VA looks at their income, because remember, this loan is a benefit to the VA buyer. So they're really going to make sure that the income that you have available to make the payments is there every month like clockwork for you to be able to be successful. But some lenders will tell a VA buyer that your debt to income ratio is over 50 or over 55 or 60. The truth is there is no debt to income ratio limit, meaning the VA will take whatever ratio is the ratio as long as it meets all of the other eligibility guidelines that are put in place for the VA. I personally have closed loans with a 75% debt to income ratio, and that was a good decision for the right reason, and everybody wins and everybody's happy, and that's what we can do when we look through what the VA has to offer, because it is a benefit. The VA wants to give you the money to be able to buy the homes that you want. Like, you earned this benefit through active duty service, through serving in the reserves. Like, this is something that you earned, and you should be able to use it because it's your right. So we're gonna run through some of these things, lock in. I'm gonna give away a lot of this stuff for free so we can kind of inform you and educate you so you become a VA loan expert just like me. The VA loan is probably an easier loan than others just because it's a zero down loan payment. There may be requirements for a down payment based on your entitlement or based on the eligibility that you still have remaining. But in general, most VA loans are able to be done with no down payment. So that makes it really easy for the bridge to home ownership, because saving money is a real challenge for a lot of people, especially when cost of goods are higher or saving money is difficult, or there's some turbulence maybe in your income to where it's been difficult to save. So having no down payment requirement is a huge benefit over any other loan program to be able to get into a house with no down payment. So that is a great tool, but it doesn't necessarily mean it's going to be an easy loan, right? There still are a lot of steps. Just like in the military, there's lots of steps and checklists and ways that you do things. The VA home loan has a lot of steps and checklists and procedures for the way that they do things. So when you're writing an offer and you're trying to make it strong, right? You're trying to make it where the seller is going to be willing to accept your offer. Now, I will say that there is a little bit of a stigma attached to VA offers, not because the VA is a bad loan prolonger, it's because the sellers and maybe the agents representing those sellers just aren't that informed about what goes on with a VA buyer. Some sellers think that VA buyers can't pay any closing costs, that there's these fees that they can't pay. And so right off the bat, the seller's going to have to pay them. It is true, the VA does have a guideline around how much a lender can charge to render a decision because they want that VA buyer to be paying fair, normal, and customary costs for a lender to render their decision. But it doesn't mean that it's automatically going to be a rule that the seller has to pay all these extra costs just because the VA buyer is giving them a VA offer to purchase their home. The other piece is really the value of the home. This is, hey, the home is listed for $300,000, you're gonna offer $300,000, but now you come with a VA offer. If they're concerned that this appraisal isn't gonna appraise, well then maybe there's some homework that needs to be done on the listing side or the seller side where they actually prepare the comparables that document that this house is really worth 300 grand. The VA does not mess around with value because it's a 100% financing loan, meaning if the house costs 300 grand, there's gonna be a loan issued on the house for what the sales price is. There's zero equity in that house from the beginning. So the VA wants to protect the VA buyer. They do not want that VA buyer to be purchasing a home and then discover after the fact that maybe they don't even have a property that's worth what they paid for it. That in the event of a foreclosure, or in the event that the VA has to take this house back, they want to make sure that that asset, that property, is truly worth the $300,000 that the VA buyer paid for it, because that's what the market dictates. So if there's homes in that neighborhood that have sold for less, probably going to come in less because that's what the market dictates. So I would not be afraid if I was a seller from accepting a VA offer because I would know that my property is worth what I'm marketing it for. So I think you just need to be mindful if you're a VA buyer when you submit your offers. Have your lender call the listing agent, have your lender discuss the terms and how we've structured it, where the seller is getting what they want to be paid for the house and the VA buyer is getting what they would like so they can acquire this property, get into it for probably the least amount of money as possible. That way the seller sells their property and the VA buyer gets the keys to the home they want to buy. Veterans and active duty service members, you really need to not let anybody waste the entitlement that you've been given. Like, this is a benefit. I keep saying it, it's a benefit, and it's the way that we choose to lend, So because it's a benefit and we know there's no minimum credit score and we know there's no debt to income ratio, the playbook is pretty much wide open for how we can help this VA buyer get the financing they need to buy the house they want. So when we're looking at some of the things that could trip up a VA loan, we need to be kind of mindful of probably 8 to 10 things that every VA buyer, every VA realtor should know in order to keep that deal on track, or at least be mindful when they're talking about this VA offer or how this is going to work. You really want to make sure that this plan in the beginning is going to be able to be executed with all the specific steps down the line. So when the closing date gets here, everything is exactly the way that we planned it to be, with a monthly payment obligation, with an out-of-pocket cost, that we're closing on the date that we're supposed to close. It's very systematic where we do this in cadence. And when you do it right, it's actually fun to buy a house. When you discuss the challenges of the mission, or you discuss the challenges of the objective, right? There's a specific way we're gonna do it. And when we do it that way, it's every time, all the time, no exceptions, no excuses, right? You deliver the promise on what you made, and that's what creates the gold experience. So we're gonna go through some of the things that I think are important to know as a VA buyer, right? So lock in, get your drink of water, and let's go through some of this stuff so we can kind of level up our VA knowledge. So number one probably issue on a VA loan is your stable, predictable, likely to continue income, right? So if you're getting paid a salary, that's easy. If you have a fixed income like VA benefits or retirement income, that's easy. But if you get paid a commission, you get paid an overtime, you get paid a bonus, you get paid on tips, you get paid on some type of income structure that kind of fluctuates week to week or check to check, VA is gonna look at that and they're gonna say, hey, guess what? I need you to be on that type of payment structure for 2 years for me to be able to use that as an effective income. 2 years is 24 months, full pull, no exceptions. So if you've been paid by the hour and you make $20 an hour and you work overtime, but you've only had that job for a year and a half, guess what? None of your overtime is going to be eligible to be used to buy that house. So your lender and you are going to be qualifying with just your base income, and that's just your hourly income, because VA is not going to give you credit for any overtime until you've had it for 2 years. I see this lots of times with other lenders because we've kind of become, as an originator, we've kind of become an application taker. We've kind of become like a customer service rep, where we just take the information that the VA buyer gives us and we use that for like an eligibility kind of review, and then we pass it on to somebody else to make a decision. So be mindful, commission, bonus, overtime, any variable income, it's gonna have to be averaged over 2 years. Your truck drivers, you get paid by the mile. Pay attention, if you get paid by the mile, then you switch to paid by the load, then you switch to paid by the day, then you switch to paid by the hour. All of those matter, so your payment structure has to be similar or the same for at least 2 years in order for it to be considered effective income. Now, you can still use that income to offset certain debts. So if you've had it for at least a year, you can do things and offset short-term debt that still has a small balance on it, but that's a different discussion. Just know your income is important. Seller concessions. So there's a lot of uncertainty or misinformation around this one. The VA will allow the seller to pay for all of the borrower's closing costs. Appraisal, underwriting, processing, title stuff, surveys, all your costs, right? The seller can pay for those. The VA will also allow the seller to pay up to 4% of things that are not normal and customary, like paying off debt. I can't tell you how many times we let the seller pay off a debt for the VA buyer so they could qualify. Paying discount points. I want a lower interest rate. The market's going to give me an interest rate of, let's say, 6% today, and I'd like to buy it down to 5%. If the seller pays for that, that's part of that 4% rule. It's totally allowed, and that would allow that VA buyer to get the payment that they want. Maybe sometimes the payment that they need, right? But that's the way you structure it to get it to work. You can have a lot of money being given from the seller and use every bit of it in order to help the VA buyer get the money that they need. So the rule is 4% in concessions, but those are only for fees that are above and beyond what a typical seller would pay. Gift donors, pretty much anybody. Like the VA doesn't even discuss gifts in the VA handbook. So a gift is like, okay, I need to buy a house and it's gonna cost me like $10,000 in closing costs, and I only have $2,000 in the bank. But my friend over here loves me so much that he's willing to give me money. It's a gift, I don't have to repay it. He wants to help me get, into my home. We could allow that friend, right? Relative, friend, coworker, anybody that has a vested interest in that VA buyer, they could give money to you in order to help you get the money you need to purchase your home you want, right? So VA is very, very easy to document gift money. You don't necessarily have to have all of your own money. If the seller was willing to give the money up front, and for some reason the house didn't appraise and they had to lower the value of the home, maybe that seller is not gonna give you that same amount of assistance. And so now you have to pivot and you have to look for another source in order to get the money that you need to still buy the home you want. And a gift donor is a really great place to go. I would also like to add that VA is the only loan that will allow you to borrow and buy. What I mean by that is, let's say you need that $10,000 to close. You thought the seller was going to pay for it, but the house didn't appraise. You still want the house, and the seller's reduced the assistance. They're not going to give you any money. So now you need $10,000 to close. You asked all your friends, your family, and everybody's like, we're tapped. We're tied up. We don't have any additional money. You're on your own. What are you going to do, right? If you've got access to credit, you can literally borrow the money that you want or need, and you can put it in your bank account, and you can use that money to buy your house with. The only thing the lender would do would be to qualify you with that additional debt. So you could talk to your local bank, get a personal line of credit for $10,000, draw it out, put the money in your bank account. Now you have the assets that you need. You can still get that done. Those are some of the things that we can help you get done when we review the plan and we have a plan B and a plan C in order to get this mission accomplished that we're trying to get you approved for your home loan. Here's one thing for occupancy. Occupancy is so easy on a VA loan because there's lots of different ways. Generally speaking, when you buy a house as a primary residence, you're supposed to be living in that house, pretty quickly after you close. So most of the time somebody is purchasing a property and then moving directly into it. So it is true that you need to satisfy the occupancy by like living in the home within 60 days of closing. Like that actually is a rule. It's on the loan documents and that's what you're supposed to do. There are situations where a VA buyer could be living in a totally different city and still purchase a home in the city that they want to. Now there's very specific ways that you can do it, but it's called intermittent occupancy, right? So I can remember when electronic signatures were just coming out, and I did a loan for a Marine who was in Afghanistan, and he bought a home here in San Antonio, Texas, while he was out there protecting our country. And you would say, well, Joel, how does he satisfy the occupancy when he's clear across the world and you're trying to buy a house here in town? VA allows for that, right? So you got to make sure that you don't have any established residence anywhere else, right? You don't own a home, you don't have any place anywhere else in the world. And then you have to also establish, like, where are you from? So if you can document that the VA buyer has a consistent presence in the community that they're trying to buy in, right? So San Antonio, Texas, that their permanent duty station, or that's where they went to school, like high school, like where that's where they were born, that's where they're from. Because if you think about it, the mentality is, where do you go when you come back, right, from serving, right? Either you're active duty and you're deployed temporarily, you're gonna come back to your duty station, well, that would be in San Antonio. Well, what if you're not even in the military anymore and you're away? Well, where do you go when you get done doing what you were doing? Like, you go home. So where's home? Well, home's San Antonio. Well, that's the whole process behind VA with the intermittent occupancy is, yes, you can buy a house as your primary residence in San Antonio if you have a consistent presence in the community documented in the past and you haven't established a residence anywhere else. Sometimes you do need to account for dual expenses, meaning I have a housing expense for rent or some type of expense when I'm away from my home that I want to buy. But VA will allow a VA buyer to purchase a home, even if they're not going to be able to occupy it within 60 days. You probably need to have a relative or somebody, give a letter that says they're going to help maintain it, but it is totally something doable through the use of intermittent occupancy. You can also use a legal dependent of the VA buyer or the spouse of the VA buyer. So your VA buyer is away, they're working, they're making money for the family unit, they're providing, they're working on their future, but they're not physically here in the city that they want to buy. If they have a legal dependent or they have a spouse that can satisfy the occupancy in certain situations, VA will allow those people to satisfy the occupancy as well, because the family needs a home, right? They need a unit that they can feel safe in, that they can live in, that they can grow a family in, and the VA considers that to be a benefit if you have sustainable, stable housing for your family unit. Rental income is a big deal. This is becoming more popular with multi-units, where people want a house hack, where they want to live in one unit and rent out the other unit. So you've got these VA buyers purchasing, 2 and 3 and 4 unit properties. Well, they probably don't make enough money to afford the entire mortgage payment of, let's say, a $500,000 house. But if you use the benefit of the rental income from the other 2 or 3 units, well then, yeah, you could use the rental income from those investment properties to help offset your mortgage payment, and now you do qualify. The trick is, you gotta have 6 months reserved, 6 months worth of payments in the bank. Well, some lenders don't know that, and they push this process down the line because they just took the VA buyer's word for it that everything's gonna be fine, and they send it off to underwriting, and underwriting conditions the file, and they say, hey, we'll go ahead and allow you to use the rental income from the subject property for these other units, but you need to have 6 months worth of reserves. You're now gonna be a landlord and a homeowner for the first time. Well, what do you do when you say the mortgage payment's $2,500 times 6 is like 15 grand or so? You need 15 grand in the bank as reserves, not just the money that you need for closing. Here's another situation. Gift funds, maybe. Probably what I would do, which we've done several times in the past. VA buyer talks to the local bank, gets a personal line of credit, dumps $15,000 into their bank account. We verify the money in their bank account as reserves, totally good to go. And what does the VA buyer do right after they close on the home? Pay back the line of credit. Totally fine, VA don't care, it's all within the rules. And so if you're working with somebody that is experienced, that is a technician, that's been there thousands of times before, those are the types of things that you can structure. So at the beginning, you know exactly how this offer is gonna work. You've got a great game plan of what happens next. And when you execute every step along the way, it's just like clockwork. You're just like locked in and getting it done. And it's actually really fun when you start checking those things off. But rental income, big deal. Now, if you make enough money and you don't need the benefit of it, then the 6 month reserves is not a requirement. so that's not a big deal. The other trick to this piece is that when you become a landlord and you don't have a history of being a landlord, hire a property manager to take care of the other units. That's going to show the lender that you have a professional, right, experienced property manager for these other units. That's another piece of being a landlord is different, and not everybody is ready for that type of responsibility. And of course, on a multi-unit, you're living right next door to your tenant. So you probably want somebody else to be a buffer to handle things that break, things that need to be fixed, payments, things like that. And the VA is going to want to know that you are capable of managing rental properties when you've never done one. So make sure you go in knowing you're going to need a property manager for those other units if you plan on using rental income to be able to offset the subject property payment. So now we're down to residual income. I said in the very beginning that the VA home loan is the best performing loan of all time, specifically because of residual income. The VA looks at your effective income. They look at what your monthly repayable income is going to be, and then they start to deduct things that are going to be required of you every month to come in with a monthly residual income factor. So just for example, it's a chart. Every VA lender goes by the same numbers. But if you are in the South, which is we are a Southern region, and the loan amount is going to be more than 80 grand. Let's say you had 4 people in the house, mom, dad, a couple of kiddos, a couple of niños, right? You would need $1,003 left in the bank for that month of income after you factored in maintenance on the house. So VA is going to say, okay, you got a $300,000 house. The square footage is, 2,200 square feet. They're going to multiply the square footage of the home times 0.14, and they're going to deduct that from your income as a maintenance factor. They're also, of course, going to deduct all of your eligible expenses that show up on your credit report, right? So car loans, student loans, credit card debt, anything that you're responsible to pay back, they're going to put those on there. They're also going to look at collections. VA is going to want to hold 5% of the balance on those collections in your monthly payment obligation. So if you do, some people do, have a couple of collections on your credit report, it's not the end of the world. It just means that the lender is going to have to count for those, because the VA is basically saying you owe somebody money, or at least they say you owe them money. And let's just say it's a $2,000 Capital One collection, and it's from years ago, from some dumb decisions. I think we all make dumb decisions when we're younger, and we have to pay for those decisions later on in life, and then we learn the lesson on what to do. But you have a collection, it's not the end of the world, it's just now we're gonna have to account for another debt, and the VA specifically says 5% of the balance, because if you were gonna make that debt whole again and you started to make payments to it, that's probably about what the payment would be if you got on a payment arrangement with it, right? So we're going to factor in maintenance on the house. We're going to factor in all of your current debts you make payments on. We got to factor in a payment for the debts you didn't make payments on. We're going to factor in federal deductions, based on what the IRS says you should be withholding for your gross income and your family unit side with your dependents. They're going to factor in Social Security deductions, right? We're backing into this thing, and we're going to pull it all the way down, and we're going to make sure at the end of the day, you have $1,003 left over. Well, that's pretty easy, but I bet you if you ask most VA lenders, they have no idea how to complete a residual income. This is one of the very first things that we do when we know we have a loan that's tight, a loan that is really, really close to being a yes versus a no. If you think through a lot of misses or a lot of wins, I think you can go back to a lot of different situations, whether it's professional sports, whether it's, stuff that you did in the military, it's by small margins that people are winning and losing. When you're in this type of competitive environment, I think every little piece of information or every little piece of I know how to do this and tweak it and make it work, and almost like picking a lock on a key where you use all of your tips and tricks to be able to get it done. You have to be very mindful that when you say yes to this deal in the beginning, it is actually going to be executable, because the residual income is a big factor. So I said there is no debt to income ratio. That is true. But if you are 41% or higher on your debt to income ratio, the VA actually says, I need a little bit more help on your residual income, right? So if your debt to income ratio is below 41%, you can have $1,003 left over at the end of the month, and you are a thumbs up, regardless of what your debt to income ratio is. Forget about credit history and forget about anything else, but I'm just talking on your residual income worksheet, $1,003 would be needed if your debt to income ratio is 41%. If you cross over 41%, which a lot of VA buyers do, Over 41% means you need to be 120% of guide, right? So now you need to add another 20% to that 1,003 to make sure you have enough residual income left over. So it's not difficult, but that's probably something you need to make sure your lender's accounted for when your debt to income ratio starts going higher, around like 50%. 55%, 60. I told you I did one at 75%. Believe it or not, that person actually had residual income, which made them eligible to use the VA benefit. But since we're talking about residual income and you're trying to look at like what the family factor is, there are ways that you can reduce the factor or reduce the residual income calculation. One is, if you're active duty, you can reduce the residual income guideline by 5%. If you are living close to a military base. So in San Antonio, we get the benefit of several different military bases. So it's easy for us, but yes, we can reduce the requirement for the residual income factor because that VA buyer has access to the military bases. They have access to the stores and the benefits and the other provisions that are offered to them as a veteran or active duty service member. So that's one way we can reduce it. Sometimes you need to reduce the family factor size, right? So family of 4 would be mom, dad, a couple of kiddos. Well, what if we needed to reduce the family factor? We could do that if we took mom off the loan, but mom would have to have an income in order to be able to sustain her debts, right? So if she has an income to sustain her debts, then we can remove her from the family factor guideline. Or if you had foster income or child support, there was money coming in from an external source for one of the children, you could remove them from the family factor as well because they have income coming in to sustain the expenses that would be tied to them. So there's ways that you can squeeze that loan and meet the residual income guideline just by reducing the family factor guideline or actually reducing the family factor size. Another great thing about the VA home loan benefit is bankruptcies. Bankruptcy, Chapter 13 is, hey, I need a payment plan. I'm going to pay you back and I'll be good on my debts. Chapter 7 is, I'm tapped out. I can't pay you back and you're on your own. So you actually can be in a Chapter 13 bankruptcy and use your VA benefit to purchase a home. Now, there's certain requirements that need to be present, but here's what they are. You have to be in the Chapter 13 bankruptcy for at least a year. You have to have successfully made all of the payments that the trustee says that you're responsible to pay, and you need to get permission from the trustee, right, for the bankruptcy court that says you do have permission to buy a house. If you have those things, you actually could be in a bankruptcy and still use your VA benefit to purchase a home. So don't just think that a bankruptcy is the end-all be-all deciding factor. You can't get one done. Even if you had a Chapter 7, there are exceptions to it. If you've been in it discharged for at least a year, if there is extenuating circumstances, death, sickness, loss of income, other issues that we can truly document. If the extenuating circumstances were outside of your control, meaning it's not financial mismanagement, like this is like a life event that happened and it's really bad, but I recovered from it and you can see that it wasn't my fault and it's not likely to happen again, it's highly likely we can use an extenuating circumstance. You would only have to sit on the sideline for a year, right, from the discharge date for the Chapter 7 bankruptcy, and then we'd have to look at it and see if we can make sense of the credit eligibility. We talked a little bit about debts. Collections are a big deal, right, when you're dealing with derogatory credit. So this is one of the great things about the VA home loan benefit, and I've done, not quite 100, but a lot of VA loans that might have had a lower than better credit score. I've done some that are 480, 500, 510. Most of the time when I look at a lower credit score file, there's reasons for it. There's because something bad happened to a good person, because something that we didn't know was going to come literally just destroyed our life. Now, if it was in the past, meaning you don't have any late pays in the last year, you don't have any collections, you don't have any derogatory, for the last year, last 12 months, you've made all of your payments on time, that means that you have a technically acceptable credit, meaning you don't have any derogatory in the last 12 months. The other thing you need to do is, have we reestablished credit for a year, right? Is there anything that you've been making payments on, that we could document that shows you've recovered from the event that was in the past and you now have acceptable credit history and you have reestablished your credit for at least a year. So it could be cell phone. It would be preferred if you had a housing obligation, like I've been renting for a year, there's some way to document that you have a housing obligation. That's a huge compensating factor. Maybe it's just you've got other car loans or student loans or debts that you've been making payments on, but if you have a horrible credit score, it doesn't mean you can't buy a house. If you have no derogatories in the last year, you can still be eligible to buy a home. And that's probably the most fun, is to take somebody who's been told no because of a minimum credit score requirement, or no because they have collections. It just means that those lenders don't know how to put a VA loan together because they don't truly understand that this is an actual benefit. And the VA wants to give them money. They want to help this VA buyer. And it's one of the best feelings you can do for somebody. Most of the time they're a disabled vet, something happened, they got medically discharged, no income, right? And then everything falls apart. It's really, really tragic, but this is a way that we can give back to these people and provide a service. And it's actually fun to be able to show them that this is what we can do. And then after a year or 2 years, if rates get better, of course you can always refinance. The interest rate, yes, is gonna be a little bit higher on a 550 credit score than it would be on a 750, but that's not VA's rule, that's the market. The market is saying, like, I'll give you money for that loan, but the interest rate is gonna be higher because your scores are lower. So it just plays into the residual income, to the credit eligibility, like all of these factors come together in order to be able to help the VA buyer. And looking at collections is not the end all be all. Now, I will say that collections have a 5% balance that we have to account for, so that could be difficult. The good news is charge-offs do not have to be considered in the monthly obligation because that vendor or that trade line's already written that debt off as a bad debt. Medical collections, those are not to be considered as derogatory because they are based on a sickness or an illness, and everybody gets sick, so VA doesn't require us to have a payment obligation. So the only ones that we need to factor into your monthly repayment debts is the collections, and 5% of those balances is what we account for. And then the other thing is you need to provide a really good letter of explanation. Like if you're gonna ask a lender to give you money for a VA home loan and you've got $10,000 or more worth of derogatory credit from 2 or 3 years ago, you need to be able to explain to the underwriter almost where they start nodding their head, like, I get it, this is what happened. Maybe need a Kleenex or something to go along with the story, but it needs to be something where it was outside of your control. This is not likely to happen again. You can see how I've recovered from it, and I'm doing things that I want to do to get my life right and get my credit right, and this is the way that I want to do. Can't you see I'm ready? Will you help me, become a homeowner, because it's been a dream of mine. And if you've been renting for a couple of years and you meet residual income and you've got acceptable credit, and the perfect cherry on top is if you got a month or two in the bank worth of reserves, like payments worth of reserves, it is highly likely that you're going to be eligible to use your VA home loan benefit to buy a house. And if anybody tells you no, it can't be done, you need to give me a call, because we're going to change that narrative and we're going to turn that no into a yes, and you're going to be surprised at what you're capable of doing, because the VA is by far the best program when it talks about flexibility within guidelines of income and credit and how the assets are used. Phenomenal program. Don't let credit be the end all be all. There's ways for you to use your benefit to help you become a homeowner. Okay, and the final one, right? So not any particular order, but I think the other one is just like your certificate of eligibility. Like, hey, you've used your VA entitlement before and it didn't go so well, so the VA had to take a claim on it. You may think you can't use your VA entitlement again. I think that's a big, misconception for a lot of VA buyers, is that they think they can't use their VA entitlement over and over and over. So you don't have an endless, amount of eligibility that the VA will give you, right? But starting in 2026, the new conforming loan limit is going to be $825, $750. So if you had used your VA entitlement before on a previous home years ago, and that didn't go so well, and it went bad, it went to a foreclosure or something happened, and that entitlement has been used, it's gone, right? You'll never get it back. You still have access to bonus entitlement, right? So if you had bought a $200,000 house in the past, and now VA says you didn't pay that back, so we've taken 200 grand away, you still have over $600,000 worth of eligible VA benefit that you could use to go buy the next house. Same thing works for, hey, I used my entitlement to buy my current home 4 years ago during COVID, and my rate's like 2.25. It's like basically a free interest rate. So I want to buy another house, but I don't want to give up this particular house. I want to turn it into a rental property and let somebody else pay it off while I go move it to another one. You have additional bonus entitlement left. So if you bought a $300,000 house, we'll just consider 300 grand gone. You still have another 500,000 that you could use to buy your next property. You can keep your current home, you can rent it out, one of the cool things about using rental income from your vacating primary, every other loan program requires that you have a lease, right? A 12-month long-term lease with a landlord and a tenant and how much they're gonna pay and what the terms are and all those different things. VA actually doesn't require a lease. If your property is in an in-demand rental community, meaning you live in a city and there's people renting properties, then you can just provide a letter of explanation that says, hey, I plan to rent my property out. We can go online to ChatGPT or get your agent to give us a fair market rent analysis, and we can put in the file that this property would rent out for X amount of money. We can use 75% of that rental income to help offset the mortgage payment. So you don't even have to have a tenant lined up in order for you to use your VA benefit again, because the VA will allow us to offset the mortgage payment with the narrative that you're going to rent it out, and that with the narrative that it's highly likely to be easy for you to rent that property out. You can buy the next home without even having a tenant lined up, so you're not bothered with who it's gonna be or showing the property or listing it. You can buy the next house, use your entitlement again, your bonus entitlement. Sometimes depending upon the sales price of the next house, there might be a small down payment, but that's an easy calculation we can share with you. But you can buy that property, lease out your current one or make it available for lease, and then find a tenant, put them all in there, and it's all seamless. Now, if you were in the country, like I live in a town of like 10 people, okay, that's probably not gonna be easy to rent, right? But if you're in a metropolitan area or a suburb, then for sure, you're gonna be able to use that rental income. But certificate of eligibility is a big deal. Get your certificate of eligibility, see how much entitlement you have left. That'll tell you what sales price or loan amount you can qualify for. You can use it again and again, right? As long as you have enough entitlement. And it's a great tool to kind of increase your real estate portfolio, right? With 100% financing, owner occupied interest rates. Just gotta live in that house for a year, right? And then VA will say you satisfied the deed of trust, and then you could turn it into a rental and go buy another one, right? I hope that this was informative. I hope that you learned a lot through all this. We kind of took it all in. You know, if you have any questions, comments, concerns, give me a call, DM me. You know, you need to like, you need to subscribe. Like, this is really good stuff that I want to share with everybody. Like the Chili Peppers say, you're going to give it away. I want to give it away. Everything that I've learned in the last 25 years of helping people through expertise and experience, I want to share with y'all so you can become better homeowners, you know, more confidence in this home buying process, and you're not caught off guard and you're confident with what you're about to do when you get ready to use your VA home loan benefit. Thanks so much.